Okay, welcome everyone to this deep dive.
Glad to be here.
Today we're looking into investing in residential rentals over in Spain, specifically Barcelona.
Yeah, we've got a report that really digs into the situation after that big change, the Ley de Vivienda, the new housing law from 2023.
Right, so our mission today is to, well, cut through the complexity, pinpoint the key changes, and figure out what it all means for you if you're maybe thinking about investing there.
Exactly. There are some, let's say, interesting dynamics at play.
So let's start with the law itself, the Ley de Vivienda. What were the main aims?
Well, fundamentally, it was about making housing, more affordable and giving tenants more protection. That's the headline.
And the big mechanism was rent control, wasn't it?
That's the core of it, yeah. They put caps on rent increases. It was 2% in 2023, then 3% in 2024.
Right.
And from 2025, they're bringing in this new index, the IRV. The idea is it's meant to be more stable than just linking rents to inflation like before.
So it directly limits how much a landlord's income can grow from rent increases.
Precisely. That direct link to, say, CPI inflation, that's gone, which is a major shift for landlords planning long-term income.
And then there's this concept of stressed areas. That sounds significant.
It is. Basically, regional governments, the autonomous communities, can designate areas where housing costs are really high as stressed.
Like in Catalonia.
Exactly. Catalonia has been active with this. In these zones, the rent caps for new contracts are stricter.
Okay.
And especially for landlords defined as large holders, they face even tighter limits, often tied to a specific reference index for that area.
And that definition of large holder changed, too.
It did. In stressed areas, it can now mean owning just 5 properties, down from 10 previously.
Wow, just 5. So that pulls a lot more landlords into those stricter rules.
Potentially, yes. It could definitely discourage holding portfolios of, say, 6 or 7 properties in those specific zones.
Beyond the rent caps, what about other costs or changes for landlords? Agency fees, things like that.
Oh, definitely. That's a big one. Landlords now have to pick up the tab for agency fees and often for non-payment insurance, too. Costs that, tenants often covered before.
So that squeezes the profit margin directly.
It does. And add to that, stronger tenant protections. Things like potentially longer lease extensions, especially in stressed areas, maybe up to 3 years. Plus, the eviction process, if it comes to that, can take longer, involve mandatory mediation for large holders. It just means regaining possession of a property is, well, potentially slower and more costly.
Which makes screening tenants even more vital up front, I suppose.
Absolutely critical now. You need to be much more careful.
Were there any carrots offered alongside these sticks? Fiscal incentives?
Yes, they did include some. There are IRPF tax reductions, potentially quite high, like up to 90%. But
there's always a but.
Right. It applies to net income after meeting conditions like lowering rent by 5% in a stressed area. So the actual cash saving, according to some calculations we saw, might only be a few €100 on a typical rent. It sounds better than it perhaps is in practice.
Okay. And there's also a tax surcharge for vacant properties.
For large holders, yes. If they have multiple properties vacant for over 2 years, up to 150% surcharge on the IBI, the property tax, designed to push properties onto the market, but could also push owners to sell or try different rental types.
Okay, so that's the regulatory picture. How does the market actually react, especially in Barcelona?
Well, this is where it gets really interesting. The report highlights what you could call a supply paradox.
Yeah.
The supply of long-term rentals has actually shrunk quite dramatically in some places. Catalonia saw a huge drop, something like 42% mentioned. Spain overall, maybe 17%.
The controls aimed at affordability might be reducing the available regulated housing.
That seems to be the effect, yes. In Barcelona, it's striking nearly half, 47%, of listings shifted to temporary rentals, not covered by the same rules.
But did rents actually fall in the regulated sector?
Not necessarily as much as you might expect. Barcelona's rents, even with controls, decreased less than Madrid's, which had fewer controls initially. And Barcelona remains super expensive. It seems controlling rents in one segment can push demand and potentially prices up elsewhere, either in unregulated types of rentals or just in nearby areas without the same controls.
Which leads us to those alternative models, like temporary rentals.
Exactly. Rentals up to 11 months, often called seasonal, became a popular way around the stricter long-term rules. But the government is catching on.
Regulation is following?
Seems so. There's new mandatory digital registration coming for short-term rentals, like from July 2025. Even renting out individual rooms, which falls under the civil code, not the housing law, is facing more scrutiny and potential future limits. The regulatory gap is closing.
What about the big players, institutional investors?
Well, the sources mention names like Blackstone actually exiting the long-term rental market in places like Catalonia, selling off properties individually.
Because the profitability isn't there anymore.
Seems that way. The capped rents and increased costs make traditional buy-to-let less attractive compared to, say, other assets for these large funds. Interestingly, the government itself has sometimes stepped in to buy some of these properties.
So let's talk money. What about yields for an investor now?
Gross yields vary a lot. The Spanish average might be around 7.5%, Barcelona lower, maybe 6%. Prime cities like Barcelona obviously have high demand and potential for capital growth over time.
But the net profit.
That's where the squeeze is, the new landlord costs, the capped rent increases. It definitely impacts the net profitability of traditional long-term rentals. Makes them maybe less appealing compared to historical returns or other investment options.
And a specific point for foreign investors, they make up a fair chunk of buyers, right? About 18%.
They do, and there's a really significant potential issue looming for some of them.
What's that?
There's a proposal, it's controversial, and faces opposition, mind you, for a 100% complementary tax specifically on non-EU, non-resident buyers.
100%. What would that mean in practice?
Well, the example given is stark. A $250,000 property could effectively cost $500,000 after taxes and fees if this went through. It would dramatically increase the cost.
That sounds like a massive deterrent.
Huge. Now it's just a proposal, and sources suggest ways people might navigate it if it passed, like focusing on new builds, which are subject to VAT, not this proposed tax, or maybe changing their tax residency, but it creates enormous uncertainty right now.
Okay, summing up then. The risks seem pretty clear. Regulatory change is always shifting. Market distortions like shrinking supply, lower net profits, trickier tenant situations, and this big tax question mark for non-EU buyers.
Those are the main headwinds, yes.
But are there still opportunities?
The report suggests yes, but you need to be smart. Using those fiscal incentives properly, maybe benefiting from the stability of demand in regulated markets, exploring the alternatives carefully knowing they're becoming regulated too.
Right.
And relying on long-term appreciation in prime cities is still a factor. Plus, maybe opportunities to buy from those big funds that are selling off assets.
So the key takeaway, the main recommendation.
It really boils down to due diligence. Intense, localized due diligence. You absolutely must understand the specific rules in the exact area you're considering, not just Spain generally, or even just Barcelona generally.
And get professional advice.
Non-negotiable.
Yeah.
Expert legal and tax advice before you do anything, especially for non-E buyers with that tax proposal hanging out there. Understand the costs, the rules, the IRV index, the large holder definition, all of it.
And screen tenants like never before.
You got it. And be really cautious about assuming those alternative rentals are a long-term loophole. Get advice there, too.
So investing in Spanish rentals, especially somewhere like Barcelona, is definitely a more complex game now after the Ley de Vivienda.
No doubt. The law has reshaped things, squeezed traditional models, pushed activity towards alternatives, which are now also coming under the regulatory spotlight.
Success isn't about dodging the rules, then.
Not anymore. It's about deep understanding and adapting within the rules, finding that balance between, the social goals the law aims for and the market realities investors face.
It leaves us with a question to think about, doesn't it? When you try to cap prices so tightly in a market with really high demand, does that inevitably shrink the supply of the very housing you're trying to make affordable, potentially making the search even harder for people down the line, looking for you to fall over?